Hey, welcome to the podcast, everybody. Thank you for joining me. Appreciate it. And for you new subscribers, we've got a lot of new subscribers coming on. And when I say subscription, I think people automatically think of paying money. This is a free subscription. It's a free podcast. You can check it out, obviously, at karleggers.com. You can go to eggerscapital.com. We post them on twitter.com/karleggers, Google+, Facebook, all those different places to get this. You can get it there. And again, if you do want it delivered to your email, you just go to karleggers.com. Up at the top right, you click here for subscription, put your email address in, and that's it. There's nothing for sale there. It's just free information. And we used to do just audio podcasts, and then we started messing around with some video back in the day, and I'd put an occasional video article up. And I got a lot of good responses from that. People love seeing the screen, looking at the charts, and I do too. So I basically have started to do just video podcasts, and so most of these podcasts are all videos. And you can still listen to them. We're still in iTunes, and so they're video in there, but if you're just driving on the road, just want to listen to them, you can listen to them as well, and I'll do my best to describe what we're all looking at that you're missing out on. But anyways, so those are the different ways, and but for those new subscribers, welcome aboard. Thank you. Appreciate it. We always do welcome questions. You can respond right after to the email. Just reply, and we'll try to answer your questions during a podcast. Well, you can see the markets were kind of down today. I have people ask me every day that I see in social places, what'd the market do today? What'd the market do today? And what I've been saying lately is the market is acting as if it's tired. You don't see the intense selling, but you do see a market that seems to be running out of steam temporarily. And it's only natural after the run it has made. But as you can see from the averages here today, the Dow Jones down about 20 points, still above 13,500. Transports up 50, and we'll get to those in a minute, up 1% on the day. Really what sticks out today is the semiconductors down 1.5%. Companies like Intel continuing to get beaten up here. Russell 2000 down, and interest rates were down, which they had been going up, back down to 1.7% if you lend your money to the government for 10 years. Dollar was a little fractionally up today as well. Well, here's the S&P 500, and as you can see, we had the breakout, of course. A couple of big days. We had a breakout day, and then we had QE3 officially announced, and that was another breakout day. And since then, the market has just moved basically sideways and looks a little tired. Now, an easy entry point would obviously be if the stock market were to pull back to this old breakout point, which was around 1420 on the S&P. Had that double top. We had kind of this, what I had called the fake out breakout, which was this day where it broke out. Everybody said, oh, it's going to break out. And then it headed down, and we went down just a little bit. And then finally we got the real breakout here, and of course QE3 here. But it's just been moving sideways ever since then. But I think for those that are bullish and wanting to get more money invested, here's an uptrend line. So this would be a spot potentially to buy. If it came all the way down to the old breakout area, that would be, somewhere between 1420 and 1440 would be a good spot to buy if you're just looking at this from a technical standpoint. Now, I will say that one thing that's happened in the last 4 or 5 trading days is that the stock market, you hear terms like overbought and oversold. Overbought just simply means that too many people have agreed that it should go up, and so everybody's bought, and everybody who wanted in is in now. And when it gets to that point, it's like a pendulum. Now it comes back the other direction, and it goes from overbought to oversold. But not all the time. Sometimes overbought stays overbought, or it simply moves sideways and works off of that overbought condition, and it just moves sideways. And I think that's what we could be going through right now. So in the short term, it's doing this while it's working off the overbought condition. So some of these oscillators and things that we watch are actually starting to come down, even though the stock market prices aren't doing that. And that's a good sign if you're bullish. But I will say in the interim term, there are a lot of things that are very extended. If you look at how many people are thinking the market's going to go up, there's a big divergence between those who are professionals and are getting a little bearish because they tend to get bearish as things go up, whereas people that, we'll call it the retail investor, people that are just kind of do-it-yourselfers, maybe have an account at Fidelity or TD Ameritrade or Schwab and kind of do this on their own, or maybe they just do mutual funds, they tend to get more bullish as the market goes up. And that's a common phenomenon. In other words, they want to chase this up, whereas the pros want to start lightening up as this goes up. That's just a function of the market. It's not to say these people are right or these are wrong, but generally speaking, people on Wall Street tend to be selling when it's going up and getting a little more bearish, and the retail investor, those not listening to this podcast or watching the podcast, they tend to chase or get more bullish as it goes up. And that divergence is getting quite wide right now. And so when it reached this levels in the past, it has been a time to take profits or at least defer buying new positions. And we could be seeing that right now. So it's something to think about in the interim. So again, just be careful. We have seen, obviously, lately in the last couple of weeks, 2-3 weeks, kind of this risk on when you look at what's working. It's financials, right? It is, and we'll just go through a couple of them here, not Zales. Financials, although I guess Zales does involve some financials because you have to pay money to buy that merchandise. But here's financials, had been looking pretty good and actually kept a little gain today. But, the last 4 or 5 days has sold off, lower profit taking. Energy, which had been very strong, again selling off. But these are areas where money has been going into, and so those have been the strongest areas that we're seeing. What has been lagging? Utilities. And I think this area right here is actually a spot that is a pretty good risk reward. I mentioned that on Twitter. If you want to follow my comments throughout the day, some days there's very little, some days there's a lot. But today I mentioned that XLU or utilities as in general look like a low-risk time. We've already had a sell-off. XLU had reached a high of about 38.5, and just the other day reached a low of 35.91. So you've seen a nice sell-off in utilities. So that's one area that the money's come out of, and it's gone into energy, financials, and small caps, kind of the risk on. Another area where money has been coming out of lately has been transports. The transportation average on the screen here, this is the IYT, which is an ETF for the transports. And this used to be an area where you could say, hey, if the transports are going down, boy, the economy's awful. And, I've thought about this a lot lately. When you look at companies, like Amazon that are shipping stuff, are things traveling FedEx, UPS more so than they are rails now? So now the transport average, if you look what was inside this ETF, you do own the FedEx, the UPS, you own some airlines, you own some rails. So it's still diversified. I don't know what the exact weighting is off the top of my head. But it's interesting that I've done a lot of research, and I don't necessarily see a huge correlation between the transports and necessarily the market. There have been times it's led to the downside. There have been times it's been false alarms. There have been times it's rallied and the market still went down. One thing I did notice in 2012 is that what we're starting to see is an opposite effect. For example, you can see the transports were up 1% today, and the stock market was down. It's almost becoming an inverse. The correlation is starting to become inverse of the stock market. So I started to look back. The last time that happened, where it was truly moving opposite of the stock market, was in March of this year. And of course, in March and April, the stock market peaked and then went through a sell-off for the next couple of months. So they were a warning early on in 2012 as far as them moving opposite of the stock market and the correlation becoming negative. We're not quite seeing it negative, but in the last few days, it seems like it has been moving kind of on its own. I think primarily why it moved up today is simply because they are oversold. And you can see transports have been really going through this zigzag pattern here. And so, those who trade technically are looking at this, and it's not exact, but they're basically saying, hey, we're in this type of range right here, and transports are on the lower end, so we expect it to go up here, and then we'll sell it when it gets back to the top. And you could probably pull that trade-off with a tight stop. Those that are looking at this fundamentally may say, hey, this is signaling some problems because if I get rid of all these lines here and just look at the prevailing trend, which we can call it the 50-day moving average, is basically heading down. And you look at companies like FedEx and so forth, and I think they had given some cautious comments here recently, and you see they are heading down as well, kind of gap down. They've been weaker and weaker. So transports have been opposite. They were the one place today that actually made some decent money. Now, an area that has been interesting to watch lately, and I haven't participated, unfortunately, has been the home building stocks. They have been pretty much on a tear, and there's really those who say, hey, housing has definitely bottomed. There's those that say it hasn't. I'm one that says, at the very least, I think it's stabilized, and it's equaling. It's getting to an area of some stabilization where supply and demand are reaching that stabilization. There's still going to be more foreclosures. There's still going to be I think a problem here, and I don't think that this is leading to say, hey, the economy is going to get much better as it has in the past. But it has led to, I think, things looking better economically than they would otherwise. And so housing has been one of the bright spots, especially from an investing standpoint. And Lennar came out with very good numbers today, but look what happened to the stock today. This thing went up to a new high, and then it was down near a low. It was going to be a big outside reversal day, and just managed to get back some of its gains and finished right around 36.96. Very heavy volume. That's a sign there that buy the rumor, sell the news type of thing, where a lot of this run up into their earnings was anticipated. So, you look at something like that. There's also XHB, which is a home builders ETF. Now, be careful with these because this isn't necessarily just home builders. This ETF contains anything that has to do with the home building process. It's not just home builders, so it's a kind of a misconception. There are home builders in there, but there's also companies. I think Home Depot's in there. There's Mohawk Industries. There's companies that contribute to the building of a house. This is a true home builders ETF, is ITB. Doesn't get as much pub as the XHB, but you can see again, broke out to a new high and then closed lower. So, and on heavier volume. So we're at a point right now where I think the home builders have probably topped out, at least for a short-term move down. And but they've been very, very strong. I wouldn't necessarily short them. I would just say if you're wanting to buy them, just be patient. And they may come back in a little bit because this is a sign of an exhaustion when it does that, when it bursts out to new high and then all the profit taking comes in. Now, we were talking about utilities earlier, and I want to bring something to your attention. This is very important, and I'm not sure a lot of you have noticed this. Maybe some of you have, some of you haven't. Depending on how you look at a chart, you may be looking at a price or a chart that's maybe a little fictitious, or it's interpreted differently. I'll give you an example here. When you look at this utilities chart here, it looked like it was maybe bottoming out around this little horizontal line I've drawn, and then it broke through, and then Friday it actually had a down day and broke down and looked like it was breaking down. And so you may say, hey, that was a good place to trigger my stop because it broke through this trend line I had drawn. And had you done a little research, you'd notice that utilities paid a dividend or went ex-dividend. So what happens is this doesn't take that into account. So let's just give an example. Let's say that utilities paid $1 dividend and this price adjusts for that, and or does not adjust for it. It just drops on that day because when a stock goes ex-dividend or an ETF or a closed-end fund, it drops by the amount of the dividend when it goes ex-dividend, and then it pays it maybe 2 weeks later on the pay date. So utilities go ex-dividend, it drops, and so you just see it drop. But you have to realize that things that pay, a 4% dividend yield or 5%, something that's material, can really adjust the way you see this price. Now what I'm doing is I'm bringing up utilities on a totally different system. This is stock charts, and you can see what happened Friday. It doesn't look like a down day. It didn't break through that trend, did it? It actually is moving up. Because what they do is they take in consideration the dividend and basically almost reinvest it. So if it paid $1 dividend and the stock dropped by $1, they just net it out to be zero. And it's much more useful because guess what? If you owned it on that day, you're entitled to the dividend. So maybe there's a little controversy how to interpret these or look at these charts, but I just think it's important that you realize whatever you're using to make sure that you take that into consideration, because utilities to me look like they're about to turn around, whether it's for a trade or investment. And from the other picture I was showing you, it looked like it broke through and it would be time to sell. And that could really change the decision whether you hold it or buy it or sell it. So be careful of that. That's basically the dividend adjusted price. Gold has been in the news lately. Obviously, QE eternity seems to be here. It means quantitative easing for as far as the eye can see. We're at QE3. Some believe it's QE4, 5, 6. The Fed has shown no signs that they will do anything different. They basically go for a few months. They jawbone. We get weak economic data. They come out. They do the next form of quantitative easing. And Ben Bernanke says, I'm going to keep doing it until I stop. And the market's perhaps getting accustomed to that. But the point is that for this time, gold has started to rally. And I had written a blog article, maybe a month or so ago, about the fact that when you look back of this bull market in gold that's been about 10 years now, you will notice that every time the gold hasn't moved for about a year from point to point, it was just getting ready to rally. And that was one of my reasons for wanting more gold. And I already owned gold, but was looking at the miners as a trade for a little more of an aggressive trade, I guess you'd call it, because they do tend to move a lot faster than the underlying price of gold. And it kind of had this double bottom in May. Late May, we had a bottom down here, and then we had basically a double bottom. Wasn't exact. But once it turned that corner and we broke out of this, I thought it was time to buy. So I did buy the miners at that point. Today I did take profits on those. You can see that I sold it when it was a little higher, but basically it ended the day down about 3 1/3%. And I do think this is probably just profit taking, but I think I can probably get these back a little cheaper. And I think what I'm doing is I'm keeping a core position in gold, the metal, while trading around the miners. Because again, if the stock market falls, and let's say gold's flat, but the stock market falls and risk is coming off, you could see the gold miners fall and gold hold up very well. So I want that core position in gold because the Fed is not telling you to sell gold, right? They're doing everything that would tell you to buy gold. So I'm keeping the core position, but taking profits, some very nice profits, about 20% on the miners, in really just about a month and a half, almost a little under 2 months. And I want that to settle in a bit. And really, the movement we saw today is the biggest kind of divergence I had seen since this run began, and just wanted to lock in some profits. So watching that closely, but again, nothing has really changed with the story. I just think got a little overheated. There wasn't necessarily a technical ceiling it hit or anything like that. It was just it stretched to the upside, and there's a lot of indicators I watched that, to me, I think at the very least it's going to move sideways for the next few days, and at the very best it'll come back into a spot where I'd like to re-enter the position. So as of today, not in the miners at all. After the bell, we had a Caterpillar coming out basically saying, hey, growth is slowing, and this just joins the long list of companies who were saying this. And I think, if you're bullish, you need to worry about earnings seasons right around the corner. What are these companies going to say? Because we're starting to see sales slow down, inventory builds, things like that. And Caterpillar is just, again, the latest company. I think Norfolk Southern last week said this, a rail company. FedEx, I think, warned maybe a week or two ago about slowing growth. Intel, and then now Caterpillar. These are all, you got a shipping company, a railroad, a technology company, and a big heavy industrial conglomerate all saying essentially the same thing. And one of the things I do is I look at a lot of these companies and what their CEO, CFO, just try to take some of those comments and highlight what they're saying. And slowing growth is a theme. You look at economic challenges and concerns, some of those highlighted words that are red flags. So again, the market right now, there's no question it's moving up, not because things are fundamentally great. It's moving up because the Fed is forcing money into the market. They're pushing money in. The banks are getting that money to work. And by default, people are saying, hey, I can't earn yield over here, so I'm going to go out and buy things that pay dividends and kind of the risk on. And they're worried about inflation, obviously, which is why you're seeing gold go up. You had been seeing oil go up. But again, at some point, the fundamentals catch up, and stocks tend to move because the profits are going up, not because a Fed chairman is pumping money into the system. So you have to be concerned for that. So even if you're bullish, at least at least have the caveat that you will have an exit strategy, because I think it'd be very difficult for most people to be extremely bullish that things are rosy in this country and they're going up for reasons that earnings are very strong and revenue's strong and people are going back to work. We're not seeing those things right now. So there are companies that are doing that, but overall, are we seeing the entire market? No, we're not. So still cautious, but again, let's observe what the market's doing and go to those spots, just have an exit strategy. And right now, up until the last few days here, it had been financials, small caps, energy, and if that profit taking comes in a little more and then we see a resumption of the buying, then you can be free to go buy that risk on, again, with an exit strategy. But right now, I think one of the better trades is utilities. It's not the most exciting, but you already have had the sell-off in them, and I think it's setting up. And it was up 1% today, so not only were transports up, but utilities were up as well. Utilities can rally if the market's down, and they can rally if the market's up. If risk is on, they may lag, but I think you can still get a positive return for that. Thanks for joining me. Appreciate it, everybody, and thank you for the new subscribers, and we'll talk to you soon. Have a great evening.